Welcome back to the program, folks. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner alongside Mr. Alan Clopine. Thanks for tuning in each and every Saturday. Hey, Alan, we got Mr. The Legend is back on the program, Paul Merriman. Paul, thanks so much for taking some time out of your busy schedule to join us again today.
Well, thanks. I wish my kids could hear that. The legend. They would laugh their tails off.
I was, prior to you coming on, Paul, I was talking a little bit about you. And I was saying, you've been in the business for quite some time. You build a huge firm. And I think now, after you retired, you're working harder and longer, trying to get more education to the public probably than ever before.
I'm having a ball, Joe. In fact, this week I talked to 60 high school teachers who teach financial literacy on how to educate young people about equities. So it is just a ball.
That is such a cool thing because I do a lot of teaching myself to retirees, and I've tried to teach to younger individuals, high school kids, and because I think there's such a lack of information, lack of education, just personal finance with our youth of, how do you budget, or, what is credit, and is credit cards good or bad, and what is interest, and how does stocks work, how do bonds work, and it's very difficult to educate individuals that have no interest at all in this stuff.
Well, I may not be what you want to talk about today, but I tell you, I do know how to get them involved, and the way you get young people involved is you show them the facts, and then you ask them to make the decision between save versus spend, stocks versus bonds. Don't you tell them what to do. You tell them what you know about it, and let them choose the right thing to do. Then you've got them involved.
Well, that's key. I think that's with everyone. I don't think they have to be young, old. They could be young,
you're
old.
Right. You're absolutely right.
And I think, because with you look at the statistics of people's retirement plans, a lot of people are a little bit behind the eight ball, to be honest with you. People are turning 65 faster than ever before, and they're not necessarily prepared. They don't know how to necessarily manage to create retirement income. And so that's why we do this show, and that's why we get really smart people like you to help our listeners, to educate them on some different things that they should know about in the overall markets or financial planning, retirement planning, and the like. So,
great. Tell me how I can help today.
Well, let's talk about it. I know before you came on, you were doing some. He's on vacation in Italy, and he's working.
Still working.
Well, I was on a small ship cruise out of the Tauk tour company. It was an amazing tour. But in the morning, it's quiet. I'm up on the deck. I've got my, this book, guys, the Matrix book from DFA. This is the greatest book ever written in the financial community. And I'm looking at the returns of small cap value versus the S&P 500. Now, what do I know about the small cap value as an index? Well, I know that it has outproduced the S&P 500 going back 80 years by about 50% a year. On that part, we got a lot of data on that, but I know why people don't want to do it. People don't want to add that asset class because they know small cap and value suggest risk. And so I think, I thought nobody ever came into my office and said, Paul, I just can't take it anymore. The standard deviation of this fund is just too high. They don't talk like that. They come and they say, I can't take this because I'm losing money, and I'm losing more money than I'm comfortable. And here's the bottom line for your listeners and for you guys, and I know you know this, the losses in the worst years for the S&P 500, the years the S&P 500 lost money, about 25% of the last 20 years, the average loss with the small cap value asset class is actually lower than the average loss of the S&P 500, 12 point something versus 9 point something. Actually less risky. And then get this. The year after the S&P 500 loses money, people are afraid. They think there's a big trend upon us, and things are going to get dicey, and out of you getting out of those more risky categories. It turns out the year after the S&P 500 loses any money, whether it's a little bit or a lot, the average return of the small cap value is over 32%. It's the worst time to be getting out.
Right. Why do people do that, Paul?
Well, I think first of all, they don't have an education. And so they don't even understand the implications of small cap versus large or value versus growth. They're flying blind based on something they heard on Wall Street. And so that when you're not educated, the decisions you make are going to be intuitive, purely intuitive. And we can't get around intuitive. We all got to fight with that. But if you really learn how investing works in your best interest, then I think when all these things happen, like 2008, there was nothing new about 2008. It had happened before. But if you didn't know it had happened before and people had lost that amount of money many times, only to come roaring back, maybe you bail out because you figure the world's coming to an end. Education is where it's at.
Well said. You know, it's funny. We were talking about the Dalbar study and the average investor versus the overall markets. The overall markets produce quite a return, but the average investor is something significantly lower.
And you know what? When I see that report, and I subscribe to that every year, so I get to dissect it just like I do my Matrix book. The thing that people forget, when you see the average return of the investors in U.S. equity funds, we have to remember that some percentage of the people, let's call it half, actually made less money than that average. In fact, some people lost money during a period of time, the S&P 500, 20 years, compounding money instead of losing it. I think 10 or 11%, as I recall the study, the last 20 years. So that average doesn't tell the whole story, because I think, what about those people who bailed out at exactly the wrong time after getting in at almost the wrong time? You know, God help them. How are they ever going to do this right if they don't, again, back to that education? And I think that's what Dalbar says, that education and diversification. People overlook the power. In fact, I'm working on an article right now, 12 lessons about diversification. It'll come out in a few weeks at Market Watch, where I do a weekly column on the retirement page. But diversification is so amazingly important, and a lot of your listeners may think, diversification means I got to have 100 stocks in my portfolio. No, it isn't even about the 100 stocks. It's the diversification of the right asset classes. You get that right, and you got a winning portfolio.
Hey, Paul, we got to take a break. Do you mind joining us for another quick segment?
I'd love to.
Well, when we get back, I want to dive in. I want to talk, because you can make complex type of information very easy to understand. And so when we talk about small value, growth, large, when it comes to asset allocation and everything else, let's just kind of break it down really simply. Our listeners then can take that information and then help them construct their portfolio the right way. So don't go anywhere. We got Paul Merriman on the line. Show's called Your Money, and it's Your Wealth.